You can make money in real estate without real estate consuming your life. If you're an experienced real estate investor who own properties, flip houses, try the BRRRR model and you're kind of tired because it consumes your life, you are not present with your family, and you want a different way to utilize your skill and experience in a different way, this video is for you because I'm going to show you how I made the transition from being an operator, flipping houses, wholesaling, owning rentals, to becoming a private money lender. So stick around because I'm going to show you how I did it. My name is Haim Maman Palman. I've been a full-time real estate investor since 2016 and I virtually wholesaled before it was cool. I owned rentals, I flip houses in the San Francisco Bay Area, and I kind of seen it all. And I made a transition to become a lender from being the operator because it just didn't fit my lifestyle. So let me show you kind of my journey because you may relate to the challenges and pain points that I experienced because you may have it right now as well. So when I started, I read this book, Rich Dad Poor Dad, and you probably read this book as well. And I decided back in 2011 to buy my first rental property. It was 2744 Dolores Street, and I will never forget it. Again, it was nice. I dealt with the property manager. He did most of the work. I did the rehab, hired a handyman, and it was nice, but it came with a little bit of headache. But I wanted more because it generated maybe $300, $400 in cash flow, and I decided to buy my second property. So this was the lowest property. I bought 2896 Chauncey in Stockton, and then I ran out of money to buy more properties in California. So I started to buy properties in Memphis, Tennessee. So it was 4399 Nile Cove, and then 3352 Schuster. And the more properties I purchased, because I've been always told that you need to buy a rental portfolio in order for you to quit your 9-to-5 job. But at this point I had like 7 properties, and it was a massive headache. The headache just grew. I started to deal with eviction all of a sudden. I started to get with tenant calls, fixing toilets, repairs, rent collection. It was the first time I had to deal with eviction, and tenants start to leave, and I need to prepare the property to the next tenant. It was like $3K to prepare it, which is a full year of cash flow. And then the roof went bad on one of the properties. That was $6,500 to replace a roof, and that's pretty much 3 years of cash flow. I did not like it, I didn't enjoy it, and I wanted to do something else because I got to real estate for freedom, and I got a job with full of headaches. I did a lot of work and I didn't get a lot of money to show for it. So I started to do wholesaling. My goal was to quit my 9-to-5 job, and I want to start to generate 5 to 10K per month, and that changed my life. I started to do that, it was nice, and then on September 30th, 2016, I quit my 9-to-5 job, and that was my Independence Day, and I went all out on becoming a full-time real estate investor, a full-time virtual wholesaling operation. I joined a mastermind, and in the mastermind, what everybody did, and they love this word, it was to scale the business. And that's what I did. I started to hire team members. I had an acquisition, I had a dispo, I had lead manager, and I started to run a Monday morning meeting, and it just started to become a real job. And I always like to tell my Santorini job, this is when I quit my 9-to-5 job. I was a full-time running an operation, and I was in a travel vacation with my family. You can see, you think everything is good, I'm happy, but the realization was that I wasn't present. My wife told me one of the biggest sentences that changed my life. She's telling me when she saw me just sitting by the poolside with no energy to play with my kids in the swimming pool because I was running a Monday morning meeting, dealing with team members' headaches, people quitting, not hitting the KPIs. I still needed to get the marketing campaign out. and it was like few $1,000s. Deals fell through and I was just out of it, and I didn't have any energy, not the physical energy and not the mental energy, to be present with my family in one of the beautiful places in the world, in Greece. And my wife told me, listen, this is why you quit your 9-to-5 job. At least when you worked your 9-to-5 job, you were present with us on our vacation. So this is when I flipped, I changed, I started to do flipping in the San Francisco Bay Area, but it was still a lot of work, and I wanted something different. I wanted to start to transition from being the operator to becoming a lender. Instead of managing projects, managing tenants and property managers, or managing operation, chasing contractors, I wanted to become the bank. I want to make sure that I deploy capital, I control the terms, and basically being the bank. That's what I wanted, and this is what I started to learn, and it was nice because it was a new way to apply my skills, but still staying in the same field of real estate investing, and this is what I wanted. So the question that you need to ask yourself, am I happy with the current business model that I have? And if you are, then it's probably not for you, and you don't want to make the transition because you really don't need to. This video is for somebody who wants to transition to have a different type of lifestyle, that they want to build something that it's more predictable, that it's less effort, less drama, and still want to apply the same knowledge, because at the end of the day, there's the old ways. And again, what most people used to teach me, or the people that I followed, that's what they're preaching. They're preaching more units, more doors. If you want to make it, if you want to do more cash flow, you need to build a portfolio with more doors, more units. And obviously, based on my own experience, based on the skill set that I had, and again, maybe you are a better manager, better delegator. For me, it meant more complexity and more overhead. I had to have more team members. I need to get more marketing out. It just was a more complex business. And again, for me, if you are good at it, if you're a good manager, good delegator, and you enjoy it, by all means, go for it. But for me, it's not something that I wanted, at least not long-term, as a way to live my life. It meant when I was doing flipping, it meant that I need to have more projects going on. And that for me meant more risk, because I needed to raise more capital for the project, to take more loans, and also I need to manage more teams, more contractors, and for me it just didn't work. So I didn't want to do that. And lastly, it was more chaos, more operational overload, more drama. And when you have that, usually you have less predictable cash flow, because if the property is not selling on the timeline that I wanted, I still had to make the payments to the lender. Sometimes I needed to wait a few months to get on the right time on the market. And if I miss the deadline, I'm getting into the holiday season, meaning that I need to wait at least 3 or 4 more months until I can sell the property at the right time. And I just didn't want that. I wanted more simplicity. I wanted to make fewer decisions, and I have a typo here. I want to make sure I have a clearer path, that I have the same type of decision, running comps, estimated repairs without doing all the work. I want to make sure that my funds are still protected by having a first position for my loan, whether it's a mortgage or deed of trust. And I want to make sure I have a more predictable cash flow. I didn't want to have 1 month $400 and 1 month $100 cash flow, or some months I had to put money out of pocket in order to do a repair or to get a property rent ready. And again, I just didn't want that. I want to make sure that I have more predictability, protection for my funds, and simplicity. And this is when I decided to change the seat at the table. Again, it's the same table, meaning that you can be the lender or you can be the operator. And the beauty of making the transition to a lender is that you apply the same knowledge. It's basically the same deals, same comps. Whether I'm evaluating a deal, I need to know the ARV, so I know how to run funds. I know how to evaluate the ARV. I know to estimate the repairs because I already did that as an operator. I wanted to know how to work with a title company. I needed to do that whether I am the operator owning the property or the lender. I also needed to, it's the same HUD statement. So pretty much it's the same deal, you're just sitting in a different seat. That's it. And the beauty is that you control the deal. You structure the deal in a way that protects you. And I will show you how I do that, because when the market changed, this is what I noticed when I was the operator. And I see that today because my borrowers are operators. So I know when they have a hard time getting out of the loan, I see what they're experiencing. I see that there's a burnout. They just want to be done. This is what happened to me. So I know how they feel doing the same project over and over again. I know that the project shrinks. It's compressed. Whether you are a landlord and you need to refinance and the interest rate is up, there's not a lot of cash flow, or when you do a flips, I see that property is sitting longer on the market, it's less predictable, and this is the challenges that I see today being the operator. But there are people who are still working and they still need capital for the deals. Buyers still buying, there's still boards, it's still real estate. People will always be willing to buy houses, whether it's people who want to build portfolio or flippers who needs funds to close their deals. Banks remain restrictive. It's harder to get a loan. There are hard money lenders out there that kind of our competition, but the harder it is to get a job, it makes our job easier and our terms more attractive, and we still can win because we provide fast funding, easier process, and certainty. My borrowers appreciate that because I can fund the deal quick and they can make money. So there's definitely a room for private money lenders to be relevant in this market, and this is the model. I developed a process about my framework. How do you become a private money lender? Obviously, it took me time to develop it. I'm not saying it that it's easy. I have over 300 loans under my belt. I lost money doing bad deals, and I developed this process from real experience. I deployed millions of dollars. As I mentioned, I lost money, I made money. I've seen the good, the bad, and the ugly. And this is what I learned in the process. There's 3 big pillars in order for you to have a good private money loans, that it's secure, it's protected, and generate double-digit return on your money. So the first thing is the position phase. This is when you develop a lending box. This is when you create a way to generate leads of borrowers that fit what you are willing to fund, and you find the right borrower. So deals always come to you, and the right deals comes to you, because what you don't want to be, it's a lender that fund deals outside of your comfort zones or outside your expertise, or just because you know somebody who came with you an opportunity but you don't know exactly what to fund, you don't have your North Star. And this is what's the lending box, what's to position yourself as lender, that you know exactly your criteria, your lending box. This is what the position phase is. Then you have the protect phase, when you basically want to protect your capital, and I will go over it in a minute. This is when you underwrite the deal. This is when you want to make sure that you get a title, insurance policy. You want to make sure that you kind of minimize the risk and protect the downside. And lastly is the cash flow phase, when you generate ways to generate cash flow that's predictable, that it's contractual income, but also you deploy the capital fast, that bump your ROI, and your money moves on schedule. You make money first, you make money on a monthly basis, and when the loan is matured, you get your money back, or you extend it and get a renewal fee. So let's talk about this in a second, because this is important. In the position phase, I mentioned that it's super important. Most lenders fail because before the deal even start. This is when you start to fund bad deals, and I can tell you from my own experience, I funded bad deals. So the first thing that you always want to do is to develop a lending box. And when I develop a lending box, I'm looking at 3 things. I'm looking at the borrower, the asset, and the terms. And what do I mean by that? What is the type of borrowers that you want to work with? You want to make sure that you looking at experience, at the exit strategy, the market, the time frame. That will help you determine if this is someone that you want to work with, if it's a good fit for you to work together, because the more experienced the investor, the better fit and the less the risk is. And number two, you want to look at the asset. You want to look at the location, what is the state that they operate in, and what is the area, okay? Because not all the states are created equal. From experience, I funded the deal in New Jersey, and it was very hard to foreclose. The states are not lender friendly. And nowadays, I fund only in 10 states, and this is based on states that it's easier to foreclose. There's no licensing requirements or redemption period, and I have kind of a criteria of what I'm looking for. I'm looking at the type of property, single family, duplexes, multifamily, land, and all of that. Again, me personally, I fund only single family homes, but I know private money lenders that will fund new construction, small multifamily, etc. You want to make sure that you understand the ARV, the condition of the property, what's the type of repairs that the property needs, because that will help you understand what you want to fund or what you don't want to fund. Because for me, for example, I don't like major rehabs, so I fund only minor rehabs. ARV, I fund only up to $200,000 loans. So I want to make sure that the ARV is probably up to $350,000 entry-level houses, single family only. But again, you need to develop it, and the most important part, it's houses that I would love to own if the deals go sideways. So if this is not a property that I would love to own, I don't fund it. So this is one of my criteria when I develop my lending box. Okay, this is all about lending box. And the terms is the LTV, what's the loan to value, what's the loan to cost, what is the interest rate, what is the maturity, basically what's the term. So I usually like 6 to 12 months loan. That's pretty much the main, again, points, skin in the game of the borrower. This is the kind of the terms. This is what I'm looking at when I'm developing my lending box. And by the way, if you want to learn more about this, you can send me a message via Instagram. Just send me 55, the number is 55, and I will continue the conversation for some. If it's a good fit, I will invite you. Obviously, I don't want to work with anyone, only with someone who wants to make the transition. They have the experience to make the transition, and they have access to funds. So if it's you, if you want to learn more about how to become a private money lender, feel free to reach out. But this is the position, because without lending box, everything would be harder, because once you have the lending box, the right borrowers will start to show up, and you start to qualify the correct borrowers with the correct deals, and it will be a much easier way to screen borrowers and to screen deals once you have the lending box. So this is the position phase, and once you have the position phase, only then you go to the protect phase. And what is the protect phase? And this is operators hope for the deal to work when lenders structure the deal so they survive even if it doesn't. What it means, I always fund in first position. Okay, I want to make sure that I get paid before everyone else, and the way I structure it, the borrower always have skin in the game. So before they walk away from the deal, they will need to make sure that I'm getting paid, because I have a promissory note, a contractual agreement that they pay me X amount of money per specific interest rate, and the loan needs to be paid off by a certain date, and everything is set. There is no operational. I'm not relying on anybody else. I want to make sure that everything is written very specifically in order for me to get paid first. And if the deal goes sideways, again, I have enough margin of safety. That's why I'm gonna fund only up to 65, maybe 70% loan to value, and that will give me the margin in case the deal goes sideways. I need to foreclose, and the hope is to recover most, if not all, of the principal plus interest plus late fees plus legal fees, and that's 30 to 35% margin. Hopefully will be enough to recover my funds and to protect the downside. What else I do in the protect phase? I want to make sure I review the title. I'm working with a legal team to structure the paperwork. I have a promissory note. I have a deed of trust to make sure that I'm in first position. I have a personal guarantee and other documents that protect me to make sure that if the deal goes sideways, I have the legal rights to and of the paperwork to start the foreclosure process in a fast and efficient way to get my money back. And also I have a title and property insurance policy in case there is a title issues, I'm protected. I have insurance policy, and if the property goes on fire, there is an insurance policy on the property, and I will be a loss payee and will get the loan amount covered before the borrowers get their money. So this is super important to make sure I am protected. So this is the protect phase. Super important to protect your capital. And I lost money sometimes because I didn't have it in writing. I didn't have the correct paperwork. I funded 85 to 90% of the loan of the ARV, and when it was time to foreclose, I didn't have enough money and I lost money. So I learned all of this. Everything that I teach you here, I learned from experience of funding 300 plus deals and also by losing money. So that brings me to the last phase. It's the cash flow phase, and the cash flow is super important because this is when we make money as lenders. So first of all, operator get paid last, lenders get paid first. What do I mean by that? So let's, for example, if this is the timeline of a deal, when you buy, let's say a flip, you first buy the property, then you renovate the property, then you lease the property, then you sell the property, and only then you make money. Okay? Same thing with a rental. You buy the property, let's say it's a BRRRR deal. You buy the property, then you renovate the property, then you rent the property, then you refi the property, and only then you make money. And sometimes you don't make money. You do all of this work, it takes you 6 to 9 months, and you make zero money for 9 months worth of work because, I don't know, the contractor stole your money, maybe the listing agent didn't do a good enough job, maybe the market changes and you miss the selling period, the spring and the summertime, and you're now getting into the winter and it's harder to sell, and you do price reduction. So you do all of this work, you still need to pay everybody during this time. You need to pay the new contractor, or if you replace a listing agent, you still need to pay them their 5 to 6% commission to sell the property. If there is a delay, you still need to, during this time, you need to still pay the property taxes, you still need to pay the insurance. If you have a loan against the property, you still need to make the loan payments. So you need to do all of that, and this is that's why I'm saying this is an operational income. You get paid last. What about a lender? A borrower bring you the deal, you underwrite the deal, and on day one, when you fund the deal, you collect points. Okay, you be first to be paid, points. That's why I'm saying you cash in at closing, and this is the points section. When you get paid and you collect it on day one. So if this is a $100,000 loan and you charge 3 points, and this is what I do, this is what I charge. 3 points, it's $3,000 on day one. On day one, this is usually a year full of interest of cash flow if this is a rental. But for me, I charge it on day one, $3,000. So this is the point. This is when you get cash in, when you get paid first. Secondly, the cash flow, you get paid monthly. What it means monthly, on the first of each month, I'm getting paid. There is a debit from the borrower's account, or they are required to pay me per the promissory note a 10 to 13% interest. So if it's a $100,000 loan, they're paying between $833 to $1,083 on the first of the month, regardless if the property is vacant, occupied, if they need to evict, if they need to make payments to a lender, whatever. They need to still to make the monthly payments on the first of the month, because this is what it's written in the promissory note. If they don't pay by the 5th, there is late fees. This is the way we structure the loan. This is contractual income, not operational income. That's why I'm getting paid on a monthly basis. And lastly, the cash is recycled. There is a maturity time for the loan to be paid off. It's usually 6 months for my loans. And on the 6-month mark, 2 things can happen. Number one, they pay off the loan, the money comes back to my account, and I can deploy it again and start again, collect the points, the interest, and do it again. So I love it because that gives me the ability to charge points again on my money. So this is option number 1. Option number 2 is that there is a delay. They can't get out of the loan in 6 months, whether because they haven't completed the refi, if they are keeping the deal as a rental, or if they are flippers, they are not able to sell the property within 6 months, and they now need to pay a renewal fee or an extension fee, and that means that it's usually 2 to 3 points, and I'm gonna get an extra payments on a $100,000 loan, which will be another $2,000 to $3,000 that will be paid to me directly on the 6 months mark, and they will continue to pay the interest. And that's the beauty of having this cash flow flywheel. I'm always get paid, and if I don't get paid, there will be consequences to the borrower. I can start a foreclosure process if they don't meet the deadline, or if they don't pay me the renewal fee. I can start the foreclosure process, get the property back, and sell it. And I had it a few times happen to me. A few times it happened when I didn't recover all the funds because I didn't follow the system. And you can see here there's a very clear system that I need to follow if I want to make sure that I minimize the risk and increase my cash flow. So this is the model that I teach. So people ask me what changed for me after becoming a lender. The business became, for me, again, I'm not saying that's going to happen for you, but this is what happened for me. It became lighter, clearer, more predictable, and more intentional, because once I funded the deal, my job is done pretty much. I just need to make sure that the deal follow the process, that the borrower complete their rehab on schedule. I'm basically getting an update every week or two about the progress when I need to release a draw for the borrower to pay the contractor. I do that so I see the progress of the deal, and my focus is basically on getting borrowers leads, new leads. And the beauty is that it's usually a repeat borrower. Once they finish a project, they're usually looking for the next project, so my funds are rolling to the next deal, and the next deal is usually easier because it's the same paperwork. They understand how I operate, I understand how they operate. The underwriting is easier, the paperwork is easier because it's the same paperwork. I only need to make sure I maintain the relationship. I check in with them. We have they keeping me update on the progress. I'm staying in touch with them. Want to make sure the deal is on timeline and on schedule, and that's pretty much it. I'm keep allocating the capital to make sure that it's not sitting idle. Sometimes I'm develop a relationship with co-lenders that getting in with me and funding deals together with me, so I can even bump higher my return on investment because I have a structure. When I bring co-lenders, I pay them a fixed income, but I'm still in collecting the points on the entire amount, and I usually have a delta between the interest rate I pay my co-lender and the interest rate I charge the borrower. So there's a delta. So I'm making my interest rates on my money, the points on the entire amount, and the delta on the co-lender funds as well. So this is pretty much it. And what I teach is basically the framework, as I mentioned, that I went over: the position, the protect, and the cash flow. There's a clear steps for each process. As I mentioned, there is the lending box that we're going to start build first. Once you join, then we're going to start to generate leads, borrowers flow, to make sure I'm generating leads for the types of deals that I'm willing to fund based on my lending box. Then I'm going to make sure I'm interviewing and qualifying the borrowers before I decide to basically form a relationship with them. And this is when the protect phase starts. I'm going to start to look at specific deals, to analyze them, to check the comps, the repairs estimate, to make sure that I can provide term sheets. I can understand what's the loan to value that I want to fund. And then I basically want to go over risk filters, going to review the title work, the insurance policy. And once we have that, we're going to start to draft the lending documents, the promissory note, the mortgage, the personal guarantee, all of this process again, step by step, so we can get to a place when we can start to cash flow. We can make sure our money working. Yield amplifier is the co-lending model, and the income control is how to make sure that we reduce even lower the chance that there will be a default, and how we protect the downside even more. So this is the framework. So in the Lender Launchpad program, we basically teach the lending lifestyle implementation program. When we work based on framework training, we want to make sure that we learn the fundamentals of becoming a good conservative lender. Then we're gonna go over deal analysis and underwriting to make sure that we follow the structure, that we want to make sure we protect the downside. We're gonna fund only deals that match our lending box, making sure that the borrower is legit, that the asset is good, and we have conservative terms that protect us. And obviously we have the community and the coaching to make sure that when you make a decision based on judgment, based on the framework that we teach, and you have another set of eyes to make sure that you fund deals that make sense, that the last thing that we want is that you're going to lose money, and what we want you is to make money and also protect your capital. So this is pretty much what we do. So who is this is for? It's only for experienced operator that ready to implement. They need to know how to buy a property, they need to know how to run comps, they need to know how to estimate repairs. This is not for a newbie. It's somebody who's looking for more predictable income. It's somebody who wants more peace and less chaos. And it's somebody that want to have their lifestyle aligned with the business model that they build, and not somebody that constantly work, constantly not present in the life of the family. Again, I'm not saying that there is no work in this model. It's just something that once you close the deal, you don't do much. As opposed to being the operator, when you fund the deal and close, this is when your work actually started. This is when you need to find the contractors, this is when you need to find the tenant, this is when you need to make sure that everything works before you see the fruit of your hard labor. So this is not for somebody who wants a quick buck. It's not somebody that wants the adrenaline, who enjoy the hustle and bustle. This is somebody who wants more relaxed process, doing the same process again, to work with the framework without managing a lot of pieces. If you enjoy that, again, this is more of a boring, predictable type business, because I want to make sure I buy my time back so I can spend it with my family and not keep chasing contractors or property managers or tenants. Okay, so if you're interested and you want to implement, again, just send me a DM on Instagram, the number 55, and then it will ask you a few questions to qualify you. And if it's a good match, we're gonna invite you to join the program. Again, it's not gonna be a hard sell. The last thing that we want is to bring somebody who is not a good fit and someone who can't close the first deal within 45 to 60 days. This is the type of person that we're looking for. So if it's you, 55, to my Instagram, and we'll take it from there. Thank you, and we'll see you inside.